In this segment, we are going to look at the calculations of income by comparing a service company to the calculation of income in a merchandiser. As we have been working with, service companies provide a service or sell time to earn their revenues. To calculate net income for a service company, we take the amount of revenues earned, less any of the expenses incurred to earn those revenues, such as salaries expense, utilities expense, rent expense, income tax expense, etc. Revenues less their expenses equals their net income. The same thing holds true for merchandisers. However, the difference between a service company and a merchandiser is a merchandising company will sell inventory to earn their revenues, as opposed to just selling their time. That results in an expense that's not incurred by service companies. That expense is the cost of the inventory that was sold to earn the revenues. We call this expense cost of goods sold. Even though it doesn't have the word expense in the title, it is an expense account, just like every other expense account we've worked with. What ends up happening is merchandisers report their revenues earned, which are the amount of revenues earned as their inventory is sold, less the cost of the inventory that is sold. That one expense, revenues less cost of goods sold, equals gross profit. Gross profit is a new calculation made and reported. As we are seeing down here with ABC Merchandising Company, they're reporting revenues earned of $150,000, less the cost of the inventory that was sold to earn those revenues, or a gross profit of $70,000. That gross profit indicates the company sold their inventory for $70,000 more than what it had cost them. That does not mean they had a net income of $70,000. Because the gross profit is the amount of profit only after that one expense, cost of goods sold, is subtracted. In order to calculate net income, we also need to subtract all of the other operating expenses that the company incurred in order to earn those revenues. So all those other expenses we've been working with, such as salaries expense, utilities expense, rent expense, supplies expense, those are all subtracted separately. Then we end up calculating net income. So in summary, income of a merchandising company is their revenues less one expense, the cost of the goods sold, calculating gross profit. We then subtract all of the other operating expenses, selling and administrative and general expenses, to get our calculation of net income.